It's a tough time to be a U.S. bond investor. Yields have been persistently low thanks to historically low interest rates. And now the U.S. Federal Reserve is expected to boost rates, pushing down the value of issued bonds. Many American bond investors can't see a way out of this conundrum. That's because many of them aren't familiar with international bond markets, where investors can find potentially greater returns as well as increased portfolio diversification. Once again, emerging markets are poised to be the drivers of global economic growth, according to Oppenheimer Funds. 10-year government bond yields as of 6/30/17 source Bloomberg as of June 30, 2017. U.S. interest rate increase of plus 109 bits per second shown as for the period from September 6, 2016 to 6/30/17. Many foreign government bonds currently offer higher yields than U.S. bonds. Those higher yields can help investors' bond portfolios stay ahead of inflation. Foreign bonds are also less sensitive to rising U.S. interest rates in general. In fact, many countries are reducing interest rates, which can increase the appeal of their bonds to U.S. investors. The Federal Reserve is currently the only major central bank that is tightening its monetary policy, said Hammond Bijal, co-head of the global debt team at Oppenheimer Funds. Most other developed nations have put their policies on hold, while many emerging market banks are cutting their rates. This creates opportunities from an interest rate perspective to take on marginally more risk for significantly more return. Only about 5% of the bonds in US-based ETFs and mutual funds are foreign issued, which suggests that many Americans may not be exposed to them as an investment. Many American investors know that investing in foreign stocks can be a good way to seek to capitalize on faster growth in foreign countries, but bonds present another such opportunity, though typically with less volatility than stocks. Growth is becoming more broad-based at this stage, Bijal said. It's gradually shifting toward Europe, Japan and the emerging markets. Investing in foreign bonds brings the benefits of foreign growth into the fixed income side of a portfolio. Corporate bonds from Europe are increasingly attractive right now, said Chris Kelly, co-head of the global debt team at Oppenheimer Funds. European companies had been very conservative in managing their balance sheets during the double-dip recession, Kelly said. Now these companies are starting to grow along with the economy, and they're starting at much lower leverage levels. Government policies are adapting to challenges such as worsening relations with the U.S. and declining oil revenues. The 2018 national elections pose a risk, as they could bring a less market-friendly party to power. Emerging markets debt also merits a closer look according to Wim van den Hoek, portfolio manager at Oppenheimer Funds. Since the shocks that rocked their economies in the 1990s and early 2000s, emerging markets have embraced policies that manage inflation, control fiscal spending and allow for more flexible exchange rates, Van den Hoek said. They've also built up currency reserves as cushions against sharp swings in overseas currency. The credit ratings of major emerging markets have improved significantly since 2000, suggesting that the likelihood of default and economic tumult has abated. In many of these countries, central banks are acting with greater independence and economic data is becoming more reliable. Meanwhile, the growth of many of these economies has been stabilizing and may be turning a corner. In our view, once again, emerging markets are poised to be the drivers of global economic growth. In some emerging market countries aren't just offering higher current yields. They also boast growing economies and supportive government policies that help ensure that bond investors will be repaid as promised. Foreign bonds help to diversify a fixed income portfolio through exposure to differing growth rates, interest rate regimes, and monetary and fiscal policies. The proof? International bond returns have historically had a low correlation 1 to traditional U.S. fixed income. When you're only invested in the U.S., you are tied to the ups and downs of the American economy. U.S. aggregate bond index. But when you diversify and invest in international bond markets, your portfolio may not be as susceptible to a single economy's downturns. U.S. aggregate bond index source Morningstar for the 5-year period ending June 30, 2017. Chart is for illustrative purpose only and does not predict or depict performance of any particular investment. Please refer to asset class representations/index definitions at end. Past performance does not guarantee future results. The upside potential of local currencies. The movement of currencies between countries can act as a long-term diversifier for foreign bond investors. Currency movements can also provide an additional source of return when the US dollar